Good morning to everyone in Business Law 2. I'm going to put up a brief. This may also be appropriate for Business Law 1, depending on what semester we're in, because we do cover corporations and business organizations in both Business Law 1 and Business Law 2. At least we do with them out. There's some overlap there. We're in the chapters dealing with now corporations. But what is a corporation? How was it formed? How does ownership control direction, if you will, in the methodology? And I'll try to give you some practical applications there because it's a little bit more simple on its surface on how to actually create a corporation for profit. With regard to registering at the Secretary of State's office, there's many guidebooks on it. And why we do it, might as well start with that. Why incorporate? Why have a corporation? Well, there's really two major rationales behind it. One is the pooling of capital. In order to really start up a business and to get assets and employees and maybe offices or manufacturing buildings and things like that, it takes a great deal of monetary um, resources, and you can't do it alone. And you might be able not to be able to raise enough money by having partners. So you might be able to try to seek money from investors. Well, why would an investor want to invest in your corporation and get a piece of the pie? Usually thought of as shareholders, being part of. That's what shareholding is the shares represent a proportional interest in the ownership of not only the capital, the physical attributes of the business, but also maybe the profits if it becomes a profitable entity. That's for a for-profit corporation. We'll talk about nonprofits and governmental corporations in a second. So the pooling of capital is one of the major reasons. The other major reason is the owners of the corporation, the shareholders, have, as long as the corporation's functioning as a corporation or keeping appropriate books, having meetings, and things of that nature, the shareholders have an absolute protection, or as close to absolute as one can get. There's something called piercing the corporate veil, which we'll talk about in later chapters, where a shareholder might, in the rarest of circumstances, have individual liability. But generally speaking, shareholders have no liability for corporate losses beyond their investment. So they can't be sued for their personal assets. So if I invest, I don't know, a couple $1,000s in Nike today, and for whatever reason Nike gets sued because of something they've done that was inappropriate, maybe stole patent processes or had a huge tort claim because their building caught fire because of negligent action and burned down an entire community, and they get sued, the most I'm going to lose is the $2,000 I invested as a shareholder. What do I give up as a result of being in a corporation? Well, I give up control. If I own common shares, and we'll get to that in chapter 33, I have the power to vote for directors of the corporation, but that's all the power I really have. I can't usually force a dividend. I can't say I want the company to move in a direction. I might be able to go to the annual shareholders meeting and voice some concerns, but the actual control of the corporation is done by the board of directors. And my control is in voting for those board of directors. Obviously, those who have the greatest amount of shares have the greatest amount of voting power. In a later chapter, we'll talk about how the different voting power can create an aggregate of voting. So, for example, uh, if I have 9 shares of stock, I have 9 votes, but could I pool all of those votes for just one of the directors as opposed to the other 10 directors and therefore have at least a chance to getting some say on the board? We'll get to that in a later chapter. I'm getting way ahead of myself. So the nature of a corporation, public corporations are things like cities and towns. Sometimes if you go through a town in Massachusetts, and a friend of mine used to go take pictures of all I think there's 351 cities and towns in the state of Massachusetts. The only reason I know that is a friend of mine was involved in a debate, and he got stymied when one of the debate moderators asked how many cities and towns are there in the state of Massachusetts, and they were way off. It's 351. I always remember that, sort of scarred into my brain. But if you drive through these towns, you often see, welcome to Haverhill or welcome to Sturbridge or welcome to Gardner, and often you'll see underneath it'll say incorporated at a certain date, and so that's a form of public corporation. Doesn't issue shares of stock. It doesn't have the goal of making a profit. And so the definition is a public corporation is created by a governmental body to accomplish a governmental purpose. Public corporations may assess taxes, impose fines, condemn property. It's pretty straightforward. A quasi public corporation are things like local municipal boards and things like that. What does quasi mean? It's in the nature of, it's similar to. Um, So a public corporation gives an example as a city, a quasi-public corporation, an example as a school board, just like I had given before. Now, private corporations, one most people consider business law, that's what you're going to be focusing on, is there's two major branches, if you will. There's the nonprofit. A nonprofit's usually designed to do some kind of charity work, religious organization. Let's see some of the other examples for a nonprofit: charitable, educational, religious, social purposes, fraternal organizations. I remember my dad was the president of the Italian club in my hometown, although he's not Italian. I don't know how he managed to pull that off. But when I was a kid, I always remember my dad being the president of the Italian club. That body was it was incorporated for the purposes of protecting the nature of the ownership of that club from potential liability, but also creating a structure of governance. And that's why they often do that in that realm. And if you can be recognized under the IRS's tax code as a recognized charitable organization, you may avoid taxation on the property you own and or the monies that you earn. They're not going to be distributed to its membership because then it becomes a profitable corporation. So not-for-profit corporations, there's a whole educational arm out there about nonprofit corporations because you may have a real good civic-minded purpose and you want to create an organization that alleviates its membership of potential liability for the acts that it's doing, and you want to create a governance system through the articles of incorporation. The way to go might be a nonprofit corporation. But we're in business law. We want to talk about profit corporations. Now, many people think of every corporation existing that issues stock must be what we think of that's exchanged on the American Stock Exchange, either through the New York Stock Exchange, the Standards & Poor, or the NASDAQ. That's not necessarily true. The great majority of corporations are closely held. And the book does a nice job talking about a closely held corporation. This is where ownership, although it may be a very wealthy or financially significant corporation, it's small in the nature of how many shareholders there are. And they're closely held in the sense that it's not exchanged on the public stock exchange. Sometimes a corporation will grow at some point or need further revenue, and then they want to become publicly traded. And those of you that are into this might already know, you hear of an IPO, initial public offering. Now you have to go through the Securities and Exchange Commission because you're going to try to raise, I believe there's a threshold amount of over $5 million. And then they have to recognize, do you have the appropriate prospectus and financial disclosure that's done to the public? And then you can raise money through the initial public offering, and that often creates a lot of excitement, and sometimes shares skyrocket, sometimes they plummet right at the initial public offering. But the thing I want to stress is public corporations are one realm of corporate existence, but the bigger one is closely held. They're not publicly traded. There's information about them. You can learn about them because in order to do business transactions with them, they need to hold themselves out as a corporation to avoid personal liability for the contracts in the nature of their engagement that they enter into for potential negligent action or tortious actions. In the S corporation, those many of you be interested in this. S corporation again can be a very financially significant business, but it's got a limited amount of shareholders. And I'm not a tax expert, but if you meet that standard of the amount of actual shareholders in it, the corporation has a drawback. Well, one of its control, you may be a shareholder, but you don't have a lot of control of the corporation because the board of directors runs it, and those are voted in by the predominant ownership interest of those who have the most shares. But in an S corporation, because it's small and there's a handful of people, I think I forgot the number exactly because I don't do taxes, the insignificant number of shareholders, you can avoid something called double taxation. Most corporations get taxed. For-profit corporations get taxed on the profit they make. So if we have a for-profit corporation and it makes $1 million in profits above cost of running the business and investments that year, they now pay a corporate income tax rate. After that's paid, they distribute the money the board of directors thinks appropriate in the terms of a dividend to its shareholders. Those dividends are now taxed by us shareholders who earn income as dividends. It's double taxation. And so that's one of the drawbacks of a traditionally publicly held corporation, and even a closely held corporation that's not an S corporation. S just stands for a demarcation under the Internal Revenue Services form of corporate entity. what makes it beautiful is it only will be taxed by the individuals that get money. So say 10 of us own shares in Acme Corporation. Acme Corporation made $10 million in profits this year. They decide to reinvest $2 million. $8 million is distributed to us in the form of dividends. We'll pay on our individual tax return as income for capital gains, but the corporation will only do a filing and not have to pay corporate income tax. It bypasses one level of taxation. So it's a very popular form of incorporation from relatively smaller ownership type of qualifications. Don't get too hung up on domestic corporations. Domestic corporations, we incorporate in Massachusetts and we're primarily doing business in Massachusetts. We're domestic. A lot of corporations are actually foreign. When you think of foreign, it goes, oh, where is it out of? Is it out of England? Is it out of France? Is it out of China? That's not what foreign means. Foreign means it's just out of state. And so sometimes you'll see a lot of corporations, not so much going on as much as it once was, but at one time, many corporations that were doing business primarily in Massachusetts were actually a foreign corporation because they were incorporated out of the state of Delaware. And I always was curious about this. Why do so many corporations seem to come out of the state of Delaware? Because the incorporation process in Delaware was much simpler and the cost of filing and opening up the corporation was much cheaper out of the state of Delaware. But you're free to do your business in any state in the United States of America, because under the full faith and credit clause, just because you're incorporated, informed, and you're a domestic corporation of Delaware, you can do business wherever you want and maybe do no business at all in the state of Delaware. They attract money or some kind of process by keeping it simple. I don't know if that's still the case today, but at one time you see a significant amount of corporations basically holding their entity out of the state. Their charter is called a charter that's issued by the state government that allows you to be a corporation, often comes out of the state of Delaware. That was true at one time. So a foreign corporation, it's simply a business being run, a corporation being run in a state other than one in which it was originally incorporated. And the other one, alien corporation, that's truly one from a foreign nation. It's incorporated out of Canada or Mexico or some other nation. That's an alien. So we have domestic, foreign, out of state, alien, out of nation. Now, formation of a corporation, usually it's an individual or group of individuals get together as promoters. They go out and set it up. They go and write up articles of incorporation. I wish the book did a little bit better job on this. What are we going to set up a corporation for? I'll give you my example, me and my friends. We were lawyers. We were in a building. We liked the building. We were renting it. We did a lot of repair work on our own. The owner was living in Oregon. He really wanted to dump that building. We got a really good price on it, so we wanted to own it. But we were worried about potential liability and financing and all stuff. And says, well, let's incorporate. And that's exactly what we did. We created an S Corp because there was small membership. And our purpose had to be outlined in order to open up a corporation. So during this period of time, we had to figure out what did we want to do as a corporation. So in the articles of incorporation, you list the purpose, the name, and there's a whole group of criteria I'll go over in a little bit. And during those stages, the corporation doesn't exist, but we might be entering into contracts. And most people that enter into contracts on the other end want to hold us individually liable. And I get that because the corporation doesn't yet exist and it may never come into existence because we might not meet the legal standards to do so. And so those people that are out getting ready to start the corporation have to do some legwork ahead of time. And during that period of time, we call those people promoters. They are usually individually liable until the corporation comes into existence. But then the corporation has to adopt and accept to indemnify the promoters for all their expenses and work, and they have to adopt the contracts that promoters entered into. But who's usually going to be on the board of directors? Who's usually going to own the control over the corporation? Are the promoters anyways, but that's not always the case. So promoters do bear some risk. Not often though, because especially in a small S Corp, the promoters are often the ones that are going to become either the president or a member of the board of directors, having a lot of control over adopting and accepting those promoter contracts. Yeah, liability of promoters. If a promoter makes a contract on behalf of the corporation prior to its incorporation, which happens quite a bit, the party's liability to the contractor is followed. Liability of the corporation. The corporation is not liable unless the corporation expressly or by implication adopts a contract. And the liability of the promoter is personally liable in the contract unless the contract expressly states otherwise. So if I wanted to enter a contract that, hey, I'm a promoter for Acme Corporation, we're going to start up this corporation. It's not yet been given its state charter. We haven't filed yet with the state. I don't want you to hold me liable. Well, that company or that entity or that person might say, "Oh, I'm fine with that. I think it's going to start up and it's going to be fine." But what's the reality? Oh no, I want you to be held primarily liable. And if you don't specifically state that you're not going to enter into contract without being deemed held harmless, it's called a held harmless clause or an indemnity clause, you're on the hook as a promoter. But again, I don't know how significant an issue is other than the technicality. You should know about it. Contract and expensive. Then we know about subscribers. Anybody buys stock in a proposed corporation or subscriber, pretty straightforward. They have to pay at least as a minimum the par value that the stock is advertised at. Doesn't mean that's what it's going to be sold at, but it has to be the minimum. So if the par value of the stock is $100, an initial subscriber has to pay $100. Later, after the initial issuance of shares of stock can be sold at whatever the market bears. So even though you paid 100 par value initially, it may become basically a huge loss later on. The stock might lose the only value of $5. Where on the other hand, you might have had par value issued at $5 and the stock goes up over the roof, is worth $150 a share. So it's only at its initial offering to subscribers. And one thing that's going to surprise you in a later chapter, I think it surprised a lot of people, unless it's a publicly traded corporation, which isn't most companies are closely held. There may be significant restrictions on how you can sell your shares of stock. You may have to offer it first to the corporation to buy back, or you may have to offer it in a secondary tier to the other shareholders, because in a small corporation, we often want to control the people that we're going to be dealing with as membership of the owning class. And you can put heavy restrictions on that. And you can even put you can sell so many shares per year. There's a lot of limitations you can put on that. Articles of incorporation. I wish the book did a better job on that. You should look. You can look at them. You can look them up online at other corporations that are incorporated through the state of Massachusetts. And this outlines what the purpose of the corporation is, what their goals are, what they're going to be for, who are the original shareholders, how many outstanding shares of stock will be issued, their person to receive service in case they need to be sued, and the address to which you send lawsuits against them. And so in the articles of incorporation will be the express powers. That's the next section on this chapter. What's the corporation for? If ours was literally to own and manage that piece of real estate down in Southbridge, Massachusetts. And obviously there are some, and that goes into the next part of the chapter, that's the direct express powers, but are there some incidental to it? Yeah, corporate name. What's interesting about that, sometimes you come creative, you want a cool, funky little name for your corporation. Be careful, you usually do a corporate name search on the Secretary of State's office in the state which we try and incorporate, because you'd be surprised how the name might be already taken. Now you got to come up with another name. It has to be unique. You can't use, I want to open up a company and call it Nike. Obviously, you're also doing a service mark or trademark infringement, but you have to have a unique name that's not used by somebody else. The other thing that brings power to a corporation is perpetual existence until such time as the corporation itself decides to dissolve, or the Secretary of State or the Attorney General of the state or a court decree dissolves a corporation. It could exist for hundreds and hundreds of years. That's the potential for perpetual ownership because it's just transferred through stock ownership. Property rights, they can own, sell, transfer, rent property. Bylaws and regulations, that's a big one. How is the corporation going to be controlled? How do we pick a board of directors? What kind of qualifications, if any, do we want to put in our articles of incorporation in the bylaws related to it? Legal action, and this is where the controversy comes up. Sometimes in politics you hear people saying, how can a corporation be a person and have rights? It's because the corporate entities recognized in law, and corporations have freedom of speech rights under the First Amendment, but they also have the right to sue and be sued. And that's why sometimes you hear that claim that corporations are people in terms of rights. Most people find that very distasteful, that terminology, but in terms of a legal entity, they often have the same rights as individuals. In the corporate seal, that's not that big a deal. Implied powers, obviously, if we're going to run a business, we have implied powers to enter contract for maybe maintenance, buying oil, because it's oil heated, things of that nature are implicit in order to run the business. Just like in the Constitution, there are necessary and proper clauses to do the functions of the government generally. There are basically implied powers in a corporation's ability to run the goals of its business. Ultra vires contracts, we're going to finish up with that for this chapter. Interesting thing about ultra vires, I love the term, it's a Latin term, it goes beyond the power which was granted. And so say our business down in Southbridge was to own and operate the the commercial rental space, and there were some residential units in this large building we had bought. Outside of that, sometimes maybe the corporation gets a little bit, the board of directors gets a little bit overly aggressive and wants to all of a sudden start, I don't know, running a talent agency across town, or open up start managing local musical groups at nightclubs. It's way beyond the power that was expressly granted. It's beyond the incidental powers, and it's beyond the implicit powers of running and owning a real estate entity for rental purposes. And that's called an ultra vires act. Shareholders can sue, saying you're going beyond the scope of the power that's given to you, and the shareholder can sue for any damages suffered. Now, sometimes it might be very profitable. Well, if it's profitable and the shareholders like what the corporation is doing in a completely different adventure, you need to amend the articles of incorporation to create those new powers. Otherwise, the contracts are deemed null and void by anybody who challenges them. Kind of makes sense. There's a lot there. There's a couple, I think, a couple of videos up related to it. Chapter does very good, better than I do, but I think I have an obligation to at least talk about these concepts a little bit. But corporations are still a viable tool. I think they're getting less popular now that we have something called the LLC, which gives you the same benefits of a tax bypass, but also removing liability, but also raising money from basically the interested parties in an LLC can raise money just as much as a corporation, but they're not publicly traded. If you want to get really big, you have to consider doing the corporation. Obviously, nonprofit corporations are still very, very significant. I'll leave you off with that. Be well, folks. Don't be afraid to reach out and ask questions or raise concerns.